Well, guys, we're going to pivot to the next article today. It is the mortgage market just had its strongest week in months. Purchase applications rose 35% from the prior weeks. And now, again, I'm going to right out the gate say this is proportionate. So 35% from the most recent weeks is substantial when it's compared to something that it just that's following. Yeah. But again, we are in the kind of the gutter as far as number of units sold this year, number of refinances done. It was a very low year for volume of mortgage originations, but this, I think, shed some light on what we are to expect in 2024. Total loan applications increased 2.8% for the week ending December 1. And again, even that's up. Yeah. So again, I think that we talked about it before, like the rearview mirror of October of the fall of 2023, October specifically. Yeah. I think that's behind us. I think we're actually looking up to some sunny skies ahead.
Yeah, no, Andy, that was the worst in a decade. October was the worst. So, I mean, I'm glad that we're out of there now. And now we can actually start seeing some light at the end of the tunnel. It certainly has felt great over the last couple of, I'm going to say week or so that we saw the rates kind of, go down. It kind of makes you feel like you can breathe. And we have seen more people actually approaching us. Now they're raising their hand and saying, hey, how do I tap into my equity? Is there a line of credit? Because people are still, Andy, still adamant of keeping their low interest rate. Because again, the majority of people we refinanced in 2020, 21, 22, I mean, they all had 2.2% interest rates. I have a client right now that wants to get an equity line of credit, doesn't want to refinance the first. Why? Because he got a 1.9%.
What?
That's what we gave him. It was 1.9.
Yeah, I saw those.
You know what I mean?
Was it a 15-year?
Yeah.
That sounds like an introductory car loan.
Yeah,
right?
exactly. So who wants to tap into that? But they're raising their hands because they're saying, wait a minute.
Everything else is up.
That's correct.
Wow.
But then it goes against, so to that point, if your credit card interest rates are going up and you have multiple credit cards, which, every American should or does. What happens when that interest rate is just way higher than, what you could have converted it into your mortgage? Well, and people don't see that. Though.
No, because Brian, what starts happening is you start charging a little bit like, okay, I'm at 10,000 here. That's manageable.
Yeah.
Okay. But, here comes another situation where, there's a family emergency. Now I have to tap in another 15,000.
Yeah.
Well, now you got 25. Okay, not a problem. That was pretty easy to do. Then they start going into another 10,000, another 20,000. Now you see 80, 90,000 at a rate of, anywhere from 16 to 24%. And here's the other kicker. A lot of people don't pay attention. What's my credit card limit? It's 10,000. Why charge you 10,500? They misread the little fine print at the bottom.
Interest goes up.
It's a different scenario now. So that's where you start kind of considering, okay, I need to get out of this because now I need to breathe once again.
Yeah, 100%.
So would you guys say that some of what we're seeing here, I know what we're seeing here locally, is this situation where people are saying, hey, I have like tons of home equity and I need to use some of that to offset this expensive consumer debt that I'm just, debt servicing every single month. Now even the purchase applications are up too. So, I think this is a part from a previous part of this episode talking about the Fed. Like I think people are done with thinking the Fed is going to increase rates. Most people are calling for a pause. Now people are forecasting there's going to be a potential rate cut. So people are, okay, cool. So maybe this is the end of the tightening cycle. Then now I can make some more financial moves. And then we're seeing that result. We're seeing that result in mortgage applications.
Yeah, no, exactly.
Well, right here it says refinance applications posted their strongest week in 2 months. The refinance index rose by 14% on a weekly basis and 10% higher than a year ago. Yeah. So for me, that incentivizes that people are now starting to see that, hey, things might not get better soon, or hey, maybe I need to make a move right now because I don't know what's going to be happening with all this uncertainty. And now they're starting to say, well, hey, even if it's at a higher rate, my means, my debts, and my cost of living at this point is more important than that low rate. And we're going to start seeing that a lot more, I feel.
Absolutely.
And think about that, 10% higher than a year ago. Were rates higher or lower a year ago?
Lower.
They were lower.
So
now we have in a higher interest rate environment, more people looking to refinance. So I think it's a reflection of a little bit of the tightening that you're talking about.
Of course.
Personal consumer tightening. We have elevated home prices, which have stayed. So equity, therefore, has stayed. And now people's choices are becoming fewer and fewer. Yeah. If the dollar ain't going as far every single month, where else am I going to get that money from? The ATM of the house.
Again, the fact is, we're at the highest consumer debt ever recorded. This is the highest.
And it's not going away.
It's over a trillion.
Wait a minute. It can.
Yeah.
But the way that we're going,
smart, if we're smart and we're able to allocate that differently.
Yeah. Well, I will tell you what. I was encouraged to see that
100%.
the FHA loan activity increased to 15%, and VA, our specialty and our favorite, the VA loan activity is up 12.8%. I mean, that's really good for entitlement to essentially help themselves in their financial positioning. So I like all this, especially coming into the end of this year and looking forward to 2024.
Yeah.
What were you gonna say, Brian? You have no thought about that?
I was just gonna say, I think people are starting to warm up to the possibility of like you don't have to struggle if you have a house and it has equity.
Like that.
So you know what I mean? So it's
that's smart.
It just goes to show you that if you want to struggle, like you're gonna struggle by choice. But if you have a house and you're a homeowner, there's a different situation. Now, if you rent, it's a different situation. But if you're a homeowner, you got equity, and you've at least bought a house in the last 3 years, there's something you can do with that. Then let it just sit there, because once more houses come in the market,
Yeah.
It's just leverage at its best.
that's it.